now?
Yes.
Okay, cool. So yeah, first let's go through some of the prerequisites involved. So what is money? So first thing is I just want to clear what is money. So what money is like something which can be exchanged for goods and or services. So goods are anything which you buy, like your electronic gadgets or property or house or anything. And services are like transport services or uh, mm, repair services or anything. So that's what money is used for. So money has a use in exchange. So money does not have inherent value as such. It has use in what you can buy with that money. Okay. So, and second thing I want to do is uh, what is interest? Wait, why am I seeing yellow marks on my screen? Like I'm seeing arrows. Akansh, is that?
Yes. I think it's visible. It's part of your presentation, is it?
No, no, no. These yellow like two arrows are not part of the presentation. Like it's there throughout. I don't know why it's that.
Yes.
No issues, Dipesh.
Okay, fine.
Thanks.
Disable annotation. Okay, fine. Let's continue. Okay, so now what is interest? Okay, so when you lend money to some person or some company, you charge them a fee. Okay, so this fee is referred to as interest. So you are the lender, you give money to the borrower. Say you give 100 rupees to the borrower, and 1 year later, the person. Okay, and 1 year later, the person or the borrower would return you 100 plus some amount of interest. So say if he gives you 6 rupees, it's like 6% interest. Okay, so this is the concept of interest. You lend money to a borrower, the borrower will give you some money after a year. Okay.
Can you hear me?
Yeah, I can hear you.
Yeah. Could you explain what interest is?
Sure. So yeah, so what happens is there are two parties. One is a lender and one is a borrower. So a lender is the person who lends money and the borrower is the one who borrows money. So you give him 100 rupees.
After you lend, when the borrower needs to pay it back, the lender can say, give me an interest of 10%, which means while you're returning the money back to the lender, you have to give him 110 rupees.
Right. So you give him 100 plus 6 rupees.
It happens in banks too.
Yeah, right. Yeah. So you give 100 rupees to the borrower and the borrower will give you some amount of money back. Okay. So this is what the concept of interest is. Okay. So now let me explain the concept of compound interest. So you have the cycle, right, where you give him 100 rupees and he gives you 106. Now what you do is you get this 106 and the next year you give him 106 rupees. So then this borrower will give you 106 plus 6% on that 106. Okay. And you repeat this cycle again and again. So this is called compound, like the interest which you receive in the end is called compound interest because you are also giving back the interest to this guy to the borrower. Okay. So this is the concept of compound interest, okay, where you give the entire money, your principal plus the interest you receive to the borrower the next year. And you do this every year. Okay. So I just want to show you the effect of the compound interest and simple interest and not doing anything on a long scale. Okay. So simple interest is basically you do the cycle, but instead of giving the 106 rupees to the borrower the next year, what you do is you just give him 100 rupees and not the 6 rupees. Okay. So you're not earning interest on the 6 rupees which you've got. You're just earning 100 interest on the 100 rupees. Okay. So that is simple interest. And this is compound interest. Compound interest is where you give the interest also back to the borrower. Like you don't need the money, so you give the money back to the borrower. Okay, cool. So as you see, initial few years, like 5-10 years almost, it won't make a very big difference. Like the difference between the compound and the simple interest values will not be a lot. Like maybe, like if it is 150, you'll get like 160. So it's not a big difference. But if you see, this is like the x-axis is the time scale. So this is the number of years. So if you go on a longer horizon, like you keep going further and further in time, your compound interest would start paying you a lot more money with respect to simple interest. So if you see your payout at the end of like almost 25-30 years in simple interest form would have just been around 250 rupees. Whereas in compound interest, it would have been almost double of 420-ish, right? So it's like you're making double the money, but you're making double the money with compound interest when compared to simple interest. Okay, and principal is just 100 rupees, so you're not increasing the principal anywhere. Okay, any questions in compound interest? Okay, okay, so those are the prerequisites. Now I want to give you the motivation of why you should start investing. Okay, first thing is inflation. So what is inflation? Inflation is I think I went on mute. Okay, yeah. Yeah. Inflation is what was it? Yeah. So inflation is the concept.
Okay, inflation.
Okay. Yeah. So inflation is the concept where like over time your value of money, like the purchasing power of your money reduces over time. Like
You can also call this demand and supply. If the demand is low, the cost is high. If the demand is low, the cost is high. And when there's a lot of supply, the cost is low.
That's a different concept, but like it's not related to inflation as such.
It's where the money increases.
About what?
It's where the money like increases. Inflation.
Inflation, it's like, okay, yeah, I'm explaining the inflation, but just hold on. Okay, so inflation is like you would have heard your parents say that hamare zamane mein, or like during our times the price of rice were like 10 rupees a kilo or something, right? Whereas now it's like it's increased so much. They tell that it's everything has become so expensive. So that is basically inflation in action. So if you look at like chart on the left, this is the price of rice over time. Okay, so in the year 2001, the price of rice was almost like 7 rupees a kg. Whereas fast forward to 2021, it's like 35, 40 rupees. Okay. So it's become like almost more than 5x in 20 years. So the point I'm trying to state is that if you kept like 7 rupees in your house in 2001 till today, your 7 rupees would not be as powerful as it used to be. Like in the year 2000, with 7 rupees, you could buy 1 kg of rice, but now you would just be able to buy 200 grams of rice with that same 7 rupees. So your money has lost value over time. That's what inflation is. Okay, I've just given an example with rice, but there are there's something called as consumer price index, which keeps track of all the goods in the market and stuff like that. Okay, so is the concept of inflation clear?
Yes.
Cool. Okay. Now, so you know why you should be investing now, because if you don't invest over time, your money will lose value. Okay. Now, why should you start now? Why can't you start like maybe 5 or 10 years later? Why? What's the hurry? So for that, let's do an experiment. So we have two people. So this is the light blue guy and this is the dark blue guy. Okay. So one of them starts investing early at like when he was 18 years old, whereas another person starts investing when he was 25 years old. Okay. Both of them have started investing the same amount of money. Both of them started with 1,000 rupees every year. Okay. And they get some amount of interest. So on their investment, they get some amount of interest. Okay. So say both of them retire at the age of 60. Like after retirement, you would not generally invest more. So that's the payout sort of thing, barrier, right? So let's see what is the impact it would create. Now, when he was 18, he started, and then when this guy was 25, he started, right? So as you see, by the time they retire, the person who started when he was 25, he gets a payout of almost like 3 lakhs, right? Whereas the person who started when he was 18 gets a payout of almost 6 lakhs. So it's like double the amount of the person who started late, right? But if you see, he would have just paid, like in terms of installments, he would have paid only around 7 or 8,000 more in the 7 years. He would have just paid around 7,000 more than the other guy. But the payout he's getting is like a lot more. It's getting almost double the payout than the other guy. right? So this is the power of compounding and power of compounding over a long term. So as you increase the time frame, your compounding really kicks in and keeps giving you like outsized returns on your investments. Okay. So this is why you should start as early as possible. Okay. So are you convinced that you should invest and you should start investing right now?
Yes.
Okay, good. Fine. So now, since everybody now wants to invest, now questions would be like, where should I start investing? How should I start investing, right? So how can you make your money work for you? Okay, there are various ways in which you can do that. Okay, first thing is like, okay, bank account. So you can have a bank account and your bank will give you some amount of money and in your savings account, and you have fixed deposits in your bank account. We'll go through them in detail. I'm just pointing out what are the various things you can do. Okay. So then there are bonds, then there are stocks, then there are mutual funds, and then there is passive investing. Okay. So these are the various ways. Okay. Let's go through them in detail. Now, bank account. So you keep money in the bank. The bank lends money to other people, some company, and gives you some amount as interest. Okay. So in savings account, you get like 3.5%, whereas fixed deposit, you get around 6%, depending on which bank it is. Okay. So what happens behind the scenes is you give 100 rupees to the bank. Say this is an FD. So FD, okay. So now FD is a fixed deposit. So fixed deposit is something like you tell the bank, hey bank, I don't need this money for at least the next year. Like there are different durations, but you say that, okay, bank, I don't need the money for at least the next year. You can do whatever you want with it, and the bank will give you like 6% on that. Cool. So you,
Or you could also keep that amount of money in a fixed deposit account and you will get an interest rate. And then maybe the next year, after it unlocks, you can get a higher amount.
right. That's the concept here. So you give 100 rupees to the bank. 1 year later, the bank will give you 106 rupees.
And this type of bank account is called a fixed deposit account.
Yeah, this is called a fixed deposit. Yeah. Okay. If you just keep it in your savings account without anything, you'll get like 3.5%. But if you keep it in like fixed deposit, you will get like a higher return because you tell the bank that, hey, I don't need that money for like this duration, and you can do whatever you want with it. So what the bank does is since it knows that you don't need the money for 1 year, it will go find a borrower and give that money to a borrower at some rate of a return, some interest rate. So maybe okay. So maybe say the bank gives the borrower at 10% return, 10% interest.
Good evening, sir.
Good evening. Good evening. Hello. Yeah. So the borrower would then pay back like 110 rupees, and the bank would keep the 4 rupees and give you the 6 rupees. Okay. So now some smart people will be like, okay, why am I paying the bank in the middle? The bank gets 10% interest, but it's giving me only 6%, right? Why can't I directly go and give money to the borrower? So that's where the next topic comes in. Okay. And so that's where you invest in bonds. Okay. Now there'll be another kind of people. They'll be like, okay, how does it make a difference? 6% or 10% interest? I mean, it's not a very big difference, just 4 rupees, right? So let me just show you an infographic where where the effect of like the return on investment, how much it matters over time. Okay. So the light blue chart is again 6% return. The dark blue is like 10%, and this orange is like 12% return. So it's basically you give 100 rupees to that guy, and over time, what your investment would grow if you get 6% every year. So this is what it would have grown to. It would have grown to almost like 1,000 rupees or something. Okay. Whereas if you give the money at 10%, you would have got around 3,000 rupees. And same thing, if you give it at 12%, you would have got around 8 or 9,000 rupees. Okay, this is over a long time frame, over like 40 years. So as you see, over a small period, 6, 10 or 12% actually don't make a very big difference. Okay. But over a long time, as you keep increasing the time frame, again, you see the effects of compounding and how even a small increase in the rate of return would make your investments grow by a large amount. Like this is almost double of 12% is more than double of what you get with 10%. Right. So yeah. So that's the effect of interest rate over time on investments. Cool. So this is why higher is better. Okay. And that's why you have something called bonds. So you can, so what the bank does is, instead of you giving the money to the bank, you can directly give money to the borrower, and the borrower will give you something called bond. Okay. So if you lend money directly to the corporation instead of the bank, you can do this something called bond. So what's the catch? Why does everybody not do this? Right? Why do you want to why do people keep money in a bank account, and why not just give money to corporations directly, right? So the point is that there is some amount of risk involved in this. Okay. So one thing you should learn is that you will never get a bigger reward without a higher risk. Okay. If someone is promising you this X%, like if your FD is giving 6%, and if someone is promising you like 10-12% returns, and he's saying that it's riskless, he's basically lying. If you want a higher reward, you have to take a higher risk. Okay, simple as that. So when you put money in a bank account, it's kind of safe. Okay. Whereas if you give money to the company, what if the company goes into losses and the company goes bankrupt? Like the company loses all your money and goes bankrupt, and he does not have money to pay you back. You lose your entire 100 rupees. For getting 2 rupees higher, you lose the entire 100 rupees. Right? So that's where the risk comes in. So let's go back to this. So in this scenario, you give money to the bank, your bank gives to the borrower. Now, even if the borrower defaults, if your bank is kind of not, and if your bank is safe, in the sense the bank does not have a big impact by the borrower, it would still give you back the 106 rupees, irrespective of what the borrower does. Okay, cool. So that is the concept of risk and reward. Okay, so if you want a higher reward, you need to take a higher risk. Okay, so that's the core concept. Is that clear? Or fine. So far we came through bonds and we got to know different risks and rewards and stuff, right? So now let's go through stocks. Okay, now what are stocks? So in the previous case, your borrower was taking money from the bank and paying some interest, right? What if the borrower goes like, hey, give me the money and I will not pay you interest, but I will give you something called as share in the company. Okay, so that's what a company does. So a company issues shares to raise money. Okay, and it doesn't give you a fixed interest as such, like in the case of bonds, but it gives you ownership over the shares you buy. Okay, so what does this mean? What does owning a share mean? Okay, so when you own a share, it gives you certain voting rights. Like if a company is going to make a decision, you can give your vote and stuff. Then there are things like you receive dividends if the company profits, and if the company decides to distribute their profits, you get dividends. And the most important thing is it gives you the right to sell your share to somebody else. Okay. For example, in the recent Zomato IPO, I think everybody would know about the Zomato IPO craze and stuff, right? So what happened was the initial investors who invested like in 2010, who believed in Zomato and invested money in 2010, almost made like 2000 times their money. So something like 10 lakhs invested in 2010 became almost 200 crores in 2021 when Zomato IPO got listed, right? So the point is that the power of stocks come because you have the right to sell your stock to somebody else. Like there are people who are willing to buy Zomato shares at this particular price, right? So that's the power of that's where the big the most important factor comes in. Like you have the right to sell your share to somebody else who's willing to buy. Okay, so what's the problem with this now? So if you see, the Indian stock market has like 5,000 listed companies to choose from. So basically there are too many companies to choose from. Okay, and it's like and going through them, analyzing them, it's just a big pain. Like not many people can do it, and it's very it's not and it's like unless and until you're doing this full time as like a full time job and stuff, it's not worth it. Okay, because it's just not worth the effort. Okay, so what people do is they made something called as mutual fund. Okay, so people who cannot analyze stocks and companies for like as a job. They have their own career to handle. What they do is they invest money in something called as a mutual fund. So mutual fund is an instrument where various people pool in money, okay, and the mutual fund invests money in stocks and bonds and other assets and produces some capital gains. So these funds are basically managed by fund managers. So these are like people who are going through stocks, companies daily. Their daily job is to do that. Okay. Now, what are the various types of mutual funds? Okay, they are like debt, equity, and hybrid. And in debt, you have like duration, credit risk, equity. There's like market cap, thematic, geographical base. There are lots of things. Okay. The problem is that too many funds to choose from. So even if you go through like duration and credit risk, there are a lot of things to choose from. Even in those, they're like subcategories and stuff. The problem is there are almost 2,000 mutual funds to choose from. Okay, and we are back to the same problem as stocks. Like now we have to analyze the mutual fund. We have to analyze what kind of stocks do they invest in and what is the philosophy of the fund manager. So again, you are back to like you doing some manual work and figuring out what to invest in, and obviously some funds perform better than the others. Okay, whereas so it's there always a chance that you might not get the best thing. Okay, so what do you do with this? Okay, so there's something called as index investing. So index investing is like uh, a, a, a type of investing where you have broad market indices. Okay, so what are broad market indices? Broad market indices are something like your Nifty 50 or your Nasdaq. Nasdaq is listed. I mean, Nasdaq is in the US, and S&P 500 is also in the US. So what are these? Okay, so let me give an example of Nifty 50. Okay. So you would have heard your parents talk about Nifty 50 or how the market has fallen or risen, right? So they generally talk about Nifty, the Nifty 50 index. Okay, so what is it? Now it's basically a collection of the 50 biggest companies in the Indian stock market. Okay, and these represent around 70% of the free float of the entire stock market in terms of value. Okay, so what yeah, so basically what I mean by 70% of the free float is that most of the money invested in the stock market is in these 50 companies. Okay, okay, and there are funds who mimic this Nifty 50 and they are called passive funds or index funds. Okay, so let me just show you an infograph of show you a chart of what it would have done. Like you don't do any analysis, you don't do anything, you just blindly invest 1,000 rupees every year, every month, and keep investing since like 2008, before the market had crashed in 2008. Okay, so if you notice, what you would see is, yeah, you keep investing your money. Yeah, this is the orange line is your investment amount, and it keeps growing. Like every month you keep increasing your investment by 1,000 rupees. You keep investing 1,000, and this is the Nifty 50 return. Okay, how your investment would have grown. Cool. So in the 2008 crash, your money fell down a lot. Like it fell down below what you had invested in. What you had invested. So this point was like there was a big market crash, and eventually the market recovered. Right. So your investment also came up. Now fast forward to like past year, again there was a big crash in the market. Okay, but eventually the markets recovered again. Right. So this is like a total blind strategy where you don't need to know anything about investing. You don't need to know anything about what stocks are there in the market. You don't need to know anything about valuation. You just keep investing in the Nifty 50 index.
Sir?
Hello?
Yeah?
Yeah.
I'm only 12 and can I buy one of this? Because even I want some like pocket money when I'm like 18
Right.
before I get a job. Could I
Right.
do it?
Yes,
Because
yes.
I'm under 18.
Yeah, you can always do that. Like you don't have to be above 18. It's like you could do it in your dad's name or someone, but I think there is something called a joint account also. I'm not sure about that. But yeah, I mean,
Could you suggest me an app in which I can do this?
so if you want to do it manually, it would be like you would have to use your dad's account and stuff. Like you'll have to use your dad's PAN card and all that. But
Which app? That's my question.
okay, app as such, you can use a lot of apps. Like there's Paytm Money, there is Grow, there is Zerodha Coin, and there are lots of apps. Like you don't, and there are also those AMC apps, like asset management companies. So they have their own apps as well.
Well, I won't have to pay any fine if I just buy one, right?
Can you repeat the question?
I won't have to pay any fine if I get caught, right?
Wait, what are you doing to get caught?
I don't know, just asking.
No, there is no getting caught as such. It's just that you need to give a PAN card because that will be linked to your account and stuff. So that you can get the PAN card only if you're above 18. So as a kid, what you can do is you can invest in your name, in your dad's name.
Yeah, that's most probably what I'm going to do.
Right. So you can invest in your dad's name. You can buy, like, there is something called as UTI index fund, Nifty index fund, Nifty 50 index fund. So that's one of the best, is what they say. So right, I'm just like giving an example there. Okay.
Yeah.
So yeah, so you can just keep investing. Like this is like a return of he's investing like 1,000 rupees every month over the years, and this is how his return profile looks like. Like this is like without any investing knowledge or totally passive.
Another
investing.
problem with the long-term what you call stocks is if you what will happen if you accidentally forget that you bought it if you take it for more than a year?
If you forget it, what
And
if
then
you
it just keeps going down without you knowing.
yeah, so that's the problem if you have direct investment in stocks. So if you bought something like a stock in 2008 and that stock never recovered till today, you basically lost the entire money, right?
Yeah.
So that's the problem with direct stock investment. Whereas if you look at the index, even though there was a big market crash in 2008, the index went down temporarily, but later on it kept increasing, right? And even in the 2020 crash, which happened like last year, you can see like it became half. Your portfolio would have gone from almost 3 lakhs to like 1.5 lakh or something. But eventually it rose much more than where it was before, right? So this is the power of like long term. Like if you are investing for the short term, equity is definitely not for you because the markets could fall 50% tomorrow and you wouldn't know what to do with it.
Yeah.
But if you have a longer horizon, you don't need to actually care about all these things at all.
Yeah.
You would always.
My dad actually got me interested in this, and like a few months ago, he bought a Bank Nifty stock, and then he got like 7,000 from that, and then he got really happy, bought another one. He lost 8,000.
Yeah, that happens. So that's why you investing in direct stocks is always a problem. Like you have to know a lot about the company, and it's not everybody's cup of tea unless and until you're doing that as a, like a career choice. Okay. What I'm trying to tell you kids is focus on what you want to do in life and leave the investing to the market. Like you just buy Nifty and just hold it for the long term. If you keep working on what you like as a career option, you would obviously earn a lot more money, and then you would have a lot more money to save, and you would have a lot more money to invest. So this is like plain 1,000 rupees investing. Okay. What if your salary, so later on your salary also will increase. So you can make that 1,000 as 2,000 rupees, maybe 4,000 rupees later on. So the point is you keep increasing the amount also, and then you will get like outsized returns that way over the long term, right? So that's the point here. So without a lot of knowledge, you can just start investing in like maybe some sort of a Nifty index fund or something like that, and you also have like other options where you have like the Nasdaq and your S&P 500. So these are like US based indices. So you can have like some sort of hello.
When I asked my dad to teach me stocks, he did, but the last week, he didn't do anything about stocks and was teaching me about banking. Why?
Wait, I didn't get the question.
Like,
Dipesh,
I
Yeah.
was asking my dad to teach me stocks. And then when he was teaching me stocks, he was teaching me banking. And then when I asked him why, he's like, this is included in stocks. Is it?
This is?
Is banking included in stocks?
I don't think I can. I mean, I don't know how. I mean, I don't know how your dad is thinking about it, but in the sense like you don't you kind of need to know accountancy sort of things, like some, not like full accountancy, but yeah, you do need to know some sort of financial knowledge if you want to invest in stuff. Yeah. You do need to know some amount of that.
Dipesh, I think we should move on to the next topic and keep the Q&A at the end of the session. Abrar, is that fine? If you can ask your questions, write down your question in the chat and probably ask them at the end of the session. Dipesh.
Yeah, sure.
Yeah. Anyway, we are almost like we are at the end of this. Like that's all I had. Like,
All
yeah.
right.
Yeah. So this is like the method where you don't. So yeah, the final closing note is you concentrate on your career. Okay. Do what you want to do, and leave all the investing in like passive in instruments like index funds and stuff. Okay. And you concentrate on your career. You earn more there, and you put your money in, and you invest whatever you earn in this. Okay. So that's how you'll keep growing your money without actually worrying about it a lot. And you can always concentrate on your making your career choices better that way. Okay. Yeah. That's all I had from my side. Any questions?
Dipesh, I have a question.
Yeah.
This is Bhavesh, right? When you invest, say in any mutual fund or any stock, how do you go about researching about your stock? Any strategy that you use, or what do you look at in a company?
Okay. So what I do personally is that I have like tried out multiple methods, because there is no method which works. Like there is no fixed method which works. So I've tried out multiple things. I've tried out things like momentum, where I see the rising stocks and just buy those. So I've done that. Then there are some things like where I buy value buys. So there I do some sort of like discounted cash flow valuation and figure out if the company is undervalued according to my uh, cash flow analysis. So that is another thing which I've done. So another thing is like I just look at what are the companies in the sector. For example, if you look at the auto sector, I just see the companies in the auto sector. I compare the financial ratios of the companies with respect to each other and figure out what is the best, like best bet sort of a thing, and try not to go into the more lower investment, like the lower capitalization firms. Like try to stick with the higher capitalization firms, because that's where you have like it's kind of more safe. So I've stuck to that.
Hello.
Yeah. Hello.
Hello, it's me, Devraj. Hi, sir. Good evening.
Yeah. Good
So,
evening.
sir, I don't have a question, but it's just a kind of statement. Right? If we want to earn like a more stellar returns, it's better to invest in growing markets like India, Vietnam, Indonesia, Egypt, and that one. Those countries are more faster in growth than say China, Japan, South Korea, and that one.
Mhm.
If you see, India's market are growing more faster than American and Chinese as well, and
Right.
India is only it's not too behind China in market cap. So like if you see since some years, whatever some years past, whatever happened in China, like it was reflected in Indian markets as well. Like if China falls, India falls. But now like even if like whole of Asia falls, like India is still in positive. It just happened some weeks ago. Like when China, South Korea, and Japan all fell 1% each, and India was it was only positive. Like whole of Asia, only India was positive. So like it's better if you invest in countries like growing economies, especially if you say in India. India has a lot of more scope than other countries, I think.
Yeah, right. That again comes up to like personal preference and what a person believes in. So if a person believes that US will do better for the next 10 years, sure, why not? Why not invest in US? If you think that in India will grow for the next 10 years, yeah, sure, why not India? And if you think China will grow for the next 10 years, yeah, sure, fine. That's again like a thematic bet. Like you are, you think that okay, this economy will do better than the rest. That sort of a thing. It's personal preference, I would say. But in general, you should try to invest in at least the US market because US economy represents like almost 40 to 50% of the world economy. So it's like huge. Okay. So you should at least have some exposure to the US stock market in that sense. Okay. Anyway, coming back to the choosing the stock, right? Where was I? So say I want to choose a stock in the auto sector. What I would do is look at the financial ratios and see where I'm getting the best bet sort of thing. And I try not to do a lot of effort there. I just look at the bigger companies and try to figure out what are the good ones with respect to each other. Like I just try to battle them out and figure out what are the key things in which one company is better and the other is not. Okay, so that is one thing. Second, another thing which I've been trying out recently is something like investing in those what do you say, those very very small micro capish companies which are doing something different, something niche. That's again a very high risk zone, so I try to invest as little as money in that as possible. It's like almost gambling, but yeah. So
I have a question.
right.
So how important would you suggest it is to say either take, what would you suggest? Like, do you take your time, like for someone who's yet to start investing, like would you take your time and study the market and then, put your foot in the water, or say you go like 50% study and then start with something small?
Okay, the thing is, okay, what do you want to do? Like, do you want to start investing in stocks or like as a hobby, or do you want to do it as like a full-time sort of a thing?
Let's say to begin with, like something full-time, like all most of the students who are maybe studying or just started working, or kids who are in school, and right, so like right now they would not be in a position to go full-time, right? So maybe let's say just as a hobby to begin with.
Right. So so as a hobby to begin with, keep most of your money in broad indices as what I had suggested, like in passive funds. And you can always have like a small party fund where you have like some small amount of money where you invest in certain stocks of your liking. So as kids, initially you would not know a lot of things, right? But you would have like a liking towards a particular company, like maybe say you like Nestle, or you like Britannia ka biscuits, you like Marico ka parachute. So these are like consumer friendly firms, right? So you can start investing in those firms. Like you think that these firms are like good and they can start that. So you can always start with something which you see, like a brand value sort of a thing, right? So those are those are the starting steps which you can do, and you keep studying about the market. Okay. So studying about the market, it's not like as a kid you still need to know a lot of things, at least in like you know finance and stuff. So the art of valuation as such is very complex, and it's a hit and miss. Like it's like 50% right, 50% wrong, and it mostly boils down to your vision of seeing the future rather than anything else. So yeah.
Okay, I think we
Does that
have
answer
another
your question? I mean,
yeah, great. So I think we have
Dipesh,
another question in the chat.
hi Dipesh, since we have some time, can you quickly tell the kids about what is Nifty 50, what is Nifty Next 50? Maybe
hello. I think you went on mute or something. Hello.
I think there might be some network error on their end.
Yeah, I think
So
but Dipesh, I think what he's trying to ask is if you can talk a little bit more about index funds. Maybe
Okay.
you can talk about one or two in little detail. I mean, what is Nifty 50?
Right. Okay. So index funds are like you have Nifty 50 and then you have Nifty Next 50. Then you have like Nifty 100, Nifty 500. There are lots of things. Okay. So the point is that it's a collection of the 50 biggest companies in the Indian
Right.
stock market. Okay. And they represent like 70% of the entire stock market in terms of value. Free float of the entire stock market. Free float is like the amount of value going on, like amount of money invested in these companies. Like tradable amount in these companies. Okay, so if you look at the Indian stock market, there are 5,000 companies almost, and 70% of all the money is there in these 50 stocks. The rest 4,500 4,000 odd companies have like only 30% of it. Okay, so these represent a big portion of the Indian stock market. Okay, so that's Nifty 50. Now, if you look at from 50 biggest companies, if you look at the next 50 biggest companies like 51 to 100, that comes under a different index called Nifty Next 50. Okay, so that's again like if you look at that, that represents around 10 or 15% of the entire stock market in terms of value. Like this represents 70%. Nifty Next represents around 10 or I think 12% or something, right? So yeah, so those are the different things. So what you can do is you can like have a ratio of investing in like, hey, I'll invest this much in 50 and this much in next 50. So that's the different thing there. And then there are like sectoral indices as well, but I would not recommend investing in sectoral indices unless you know what you're really doing. Is that enough or?
Yeah.
We have a question in the chat. So it is by Vigneshwar. So it says, sir, is it wise to invest in stocks in other countries because their money value is larger, like 1 USD is equal to 72 rupees approximately. So is it wise to invest in stocks of other countries? By Vigneshwar.
Right. Yeah, it's definitely wise to invest in other countries in the sense, at least the bigger economies like the USA. It's investing in like smaller countries like maybe like very small countries. It's kind of risky because they could go bankrupt. I mean, it depends on the country again. But yeah, investing in big countries like US, which represents like 40% of the world economy, and China, which represents like around 10-12% of the world economy. So those are slightly better at least. And it's and what happens is you also get a hedge on the Indian rupee. So say your Indian rupee is not doing well, and if you've invested in the US stock market, you would get a return on that as well. Like as your Indian rupee falls, like right now it's 72, say it becomes 80 or 90, your investment would have increased just by the virtue of rupee falling. So it's definitely good to diversify in that way, but try not to go into those smaller countries where there are unknown things unless you know what you're actually doing. Like for a blind to go into it blind is definitely not the way to. If you're investing in smaller countries.
Excuse me, sir. So the question that you were answering. So like it's better to invest in developing countries other than developed countries, right? Like
that's can you mute yourself? Yeah, good. So that is again depending on whether you can take the right call. Okay, so if you look at developing countries, okay, not all the countries will become developed. Okay, there will be some countries who will forever remain developing, or they will go from developing to non-developing. Okay, so not everyone can become the US. Okay, remember that. So it's basically like your bet. Like you think that okay, this country will become bigger, so it's a bet on that. Okay, so that's again like personal choice, right? So as an Indian, it is better to just have investments in your country and maybe just the US. So even these two are good enough, I would say. And other developing countries, I mean, we already have India as the emerging market, right? So that is a developing country which you can get a good exposure to anyway, just to direct Indian stocks, right? So that is good. Plus, you just invest in US market because that is already developed. So you'll just try to diversify in that sense, so that even if the Indian stock market maybe goes through a crash, your US investments would keep you in the buffer sort of. Like they would probably not fall as much. That's again just diversification. Does that answer your question?
Yeah.
Cool.
Okay. Any questions? From anyone else? Any questions? You can either unmute or you can drop it in the chat.
Okay. So just as a closing note, are you convinced that you should be investing and you should be starting as early as possible? Are you convinced with that? Like if there's anybody who's not convinced, just tell me. I'll try to make my point better.
Hello.
Yeah.
My papa, he uses many apps in stock trading. So which app is the best app that he can just do?
Stock trading, I don't know. I use Zerodha, but yeah, you can use any of those HDFC securities or ICICI securities. But yeah, it does not make a big difference as such. It's just that some of them give you lesser brokerage than the others. The Zerodha is like a zero brokerage sort of thing. So that is probably one of the best. That's what I also use.
Okay, thank you.
Yeah, okay, Dipesh. So if you had to say put it in one golden advice for the young kids like who've attended today, to either someone who's already started their journey with shares, maybe in guidance with their parents, or someone who's yet to begin. So what would you put it across as?
Okay, so someone who has say started investing in stocks, I would say that okay, if you would have started maybe last year, you would have got very, very happy because of the outsized returns in the bull market and stuff. But it's not always like this. Things are not always this great. Okay, so don't get carried away too much with this, and try to, at least in your initial stages, try to stay with the large market cap companies because they are slightly safer than other stocks at least. Okay, and another thing I would say is keep your portfolios diversified. Like if you have stocks, if you're directly investing in stocks, keep your portfolios diversified. Like own at least like 25-30 stocks, and don't keep all your money in one or two stocks. Like that is a recipe for disaster. Okay, so keep at least like 25-30 stocks or different companies. Okay, and try to keep them in the large cap sort of a space if you're just trying out investing, starting. And for people who have who want to start, I mean, yeah, I think the same advice would go even for those who want to start. Yeah.
Okay, great. Again, does anyone have any questions they'd like to ask before we sort of bring it to a close? Anyone? All right, no questions. Okay, okay, Bhavishya, so we'll end the session then.
I'm sorry, I have
Okay.
one question. Do you have
Yeah.
any mediums through which we can invest directly in?
I think I lost you in the middle somewhere.
Oh, my question was, do you have any mediums through which we can directly invest?
What do you mean by directly invest?
Like instead of Nifty 50, like we ourselves.
Right. So then you can just have like a brokerage account. You can open a brokerage account with Zerodha or something, and start investing in stocks directly.
Oh, okay. Do you have any recommended amount if we should invest, like if you're doing Nifty 50 or directly, either way?
Just start off with like this is a long run, okay? So you don't invest everything in one shot. You will probably have some sort of like income, right? You'll have like either
Yeah.
pocket money or some income from your job or something like that. So try to save as much as possible. Okay. The concept is that the more you save now, the more outsized returns you'll get later on. Okay. Right. So that is one thing. Second thing is try to focus on developing yourself, because if you develop yourself, you will get better opportunities in your career. You will earn more. If you earn more, you will save more and invest. So that's what I would suggest. Just work on yourself, work on your career, leave the investing to the market.
Thank you.
Okay.
Great. Any final question? One last question. We have like
I
few
not a
minutes.
question, but a statement like for y'all out there, if y'all want to start like trading, not proper trading, but y'all can use this app. It's called Money by Investor, and it's like basically virtual money you're gonna get. You're gonna get 1 crore cash, and like you can invest in whatever stocks or bonds or mutual funds, FD and all. So it's quite good. Like if you're an amateur and you want to.
Okay, so this is like a virtual platform. Okay.
Yeah.
Okay.
Yeah, there are many like that. So there's another called
really-
Stock Trainer where they give you 5 lakh cash and then you can do it virtually. It's just practice if you
Yeah,
don't
it's good
directly
for
want to go into the
practice.
market.
Yeah.
Right. But
So before you
remember
get into
that
the market, you
investing
should
is like
try
a
it.
long-term game. So you need to stay and hold on to your investment for a long time. Only then you'll make a lot of money. Okay. Just don't like if the markets crash, don't
Don't
don't be
panic, sell.
scared, don't panic, don't sell. Just hold on to your investment. At least broad indices. Certain stocks, if you have direct investments in certain stocks, then that's a different ball game. But at least if you're in like broader indices, don't panic sell. Okay. And investing is like a long-term game. It's not a sprint. It's not like you'll make 10x money in one year. It's not like that. Okay. It's a marathon. It's not a sprint. Okay.
All right. Okay, great. So with that, I think we come to a closure of this masterclass with Dipesh. And I thank you, Dipesh, for taking this session for our students from Education10x. And I hope everyone who's attended today got something to take away from the session, and they are looking forward to making use of those inputs that you've given and play the long game, like you said, like it's a long run.
Yes.
Yeah. So thank you so much, Dipesh. With this, we'll call the session to an end. And thank you all for being a part of today's session. And have a great weekend.
Good. Thank you guys. Thank you for the opportunity.